Hello, and welcome to the Certified Equity Professional Exam Overview webinar for Level 2. My name is Pam Chernoff. I'm the Curriculum Coordinator here at the CEP Institute. This segment of the webinar is focused on accounting, and this webinar is provided to assist you in your exam preparation process. This Level 2 webinar is being conducted by Steve Tamsula, CEP, who is Director at Aon Equity Solutions. He's also a member of our curriculum committee, so he knows the curriculum very well. So on Level 2, accounting will be 20% of the exam questions. You have a 110 question test. So you'll probably see a little bit more than 20 questions. We have 10 of the questions on the exam are unscored items that we are trying to collect performance statistics on. Those are not identified, so you won't know which 10 they are, but because those exist, you are likely to see a few more than 20 questions on accounting on your test. And then this list just goes over some of the definitions and concepts that are covered in Level 2. And with that, Steve, I'll hand it over to you.
Okay, thank you very much, Pam. Okay, on the next slide, let's jump into and start talking about the accounting process. So that process starts with determining a fair value for the various types of equity granted to employees. And a word of caution, the phrase fair value is an accounting term, whereas the phrase fair market value is a term used to reflect the value of a company's stock on a given date, such as a public company's closing stock price on the New York Stock Exchange. So for stock options, you determine a fair value for accounting purposes by using an option pricing model. The most common one is the Black-Scholes, but you should be familiar with the concept of lattice models as well. Lattice models use a decision tree approach to determine an option's fair value. These models create a tree or lattice of possible future outcomes, which are then combined to calculate a fair value. Many different lattice models exist, such as binomial or trinomial, and lattice models use two additional inputs versus a Black-Scholes model. One is the suboptimal exercise factor, which is the ratio by which a stock price must increase before employees are expected to exercise, which is suboptimal since employees won't wait until the very last day of the option term. And second, lattice models also take into account the likelihood that an employee will exercise earlier due to termination or some other reason. And because of these additional input factors, lattice models will usually give you a different overall fair value versus a Black-Scholes model. And rest assured, you will not be asked to perform any model calculations on the exam, but you should be familiar with what they are, including the different inputs used along with their impacts on fair value. Then for restricted stock awards in units, you can just use the fair market value of a company's stock on the grant date. But take note that if dividends are paid on the company's stock but are not paid on the grant awards, then the fair market value is discounted to reflect that general shareholders are getting a benefit that the employee grant holders are not getting. Therefore, you discount the fair market value to reflect this lack of a dividend benefit to the grantees. Then for performance awards, ones without a market condition, just use the fair market value as the starting point for the accounting. However, if the performance awards do have a market condition, which is a condition tied to the company's stock price, then you must use a sophisticated pricing model, generally a Monte Carlo simulation. And the fair value will take into account the probability that the market condition may not be met, which usually results in a discount or reduction to the accounting fair value. Okay, with that, let's go ahead and move on to the next slide. And let's talk about some other issues here. Like public companies, private companies must follow the same option pricing rules, but most will have to get an outside valuation done to determine their fair market value. And they may have trouble with the volatility and expected life, two inputs that usually do not have historical information to rely on like a publicly traded company would have. For the volatility estimate, private companies can look at peer companies. Some use 4 or 5, or you can use as many as you want, but choose companies that are similar to yours and if and where possible. And for the expected life assumption, whereas most public companies have a history of option exercise patterns, private or recently public companies do not have such a history. And so the FASB came up with what they call SAB 107, which is a simplified method that can only be used for plain vanilla options and which can be used by both private and recently public companies. SAB 107 allows you to use a simplified method to estimate the expected life. And then SAB 110 came out, which extended how long companies are allowed to use this simplified method. And by the way, SAB stands for Staff Accounting Bulletin. So what is the simplified method? Well, you take the midpoint of your average vest period plus your contractual term. So in the example on this slide, our private company offers options with 4-year graded vesting and a 10-year term. The weighted average vesting period is just a simple calculation where we arrive at 2.5 years. So the expected life is the midpoint of that vesting period and the contractual term. So we add 2.5 to the 10-year term, divide by 2 to come up with an average expected life of 6.25 years. This is a good way for companies to estimate their expected life that do not have a history to rely on. Okay, on to the next slide. So generally, grants and awards fall into 2 categories: equity awards and liability awards. Equity awards settle in stock and allow for fixed accounting treatment, where you set the value on the grant date. The fair value is calculated at grant and is not adjusted during the award's life. Liability awards, however, settle in cash and in most cases require mark-to-market or variable accounting treatment. And there are some examples here on this slide. But there are a couple of unique nuances for determining if a liability award will eventually settle in cash or stock. First, if the employee has the choice between cash and stock settlement, or if the choice is outside of the company's control, then liability accounting is triggered. And second, if the company decides the form of settlement, then liability accounting is required only if the company has demonstrated a pattern of paying in cash instead of shares. In general, liability accounting is a less friendly accounting treatment. You don't know the actual expense until the measurement date, which is the settlement date, and not at the grant. But you still have to record expense starting at the grant. And so you end up recording an estimate of the fair value, which then must be recalculated and adjusted each reporting period until the settlement date. And then you do a final true-up at the settlement date. Okay, with that, let's move on to the next slide. And let's talk now about establishing a grant date. So determining a grant date for equity awards is conditional on meeting certain criteria. For equity awards, a grant date can only occur when 4 conditions have been met. First, the company and the employee have a mutual understanding of the key terms and conditions of the award. Second, the company is contingently obligated to issue equity to an employee who renders services. Third, all the necessary and required approvals for the grant have been attained. And finally, the employee begins to either benefit from or be adversely affected by changes in the company's stock price. So 2 of these conditions are not as cut and dry, and more information about that is listed here on this slide. If shareholder approval of the plan is required, which generally is the case for all exchange-listed companies, then you must have obtained this approval before you have a grant date. And all of your approvals, you may not be able to get your awards out to your employees immediately. But under the accounting standard, you are allowed a relatively short period of time to do so. And while there is no hard line limit for this in the standard, a few weeks to a month is usually the norm. Okay, with that, let's move on to the next slide and the next topic. So now we have a fair value for the award and we have a grant date. Now then, how do we record the accounting expense? The concept of a requisite service period is among the most important concepts in ASC 718. The requisite service period is the period over which an employee is obligated to render service to earn a granted award. It is also the period over which compensation costs is attributed or amortized. And ASC 718 defines 3 different types of service periods. The first is an explicit service period. This is where the term is simply stated in the award. For example, your award vests in 4 years and vests 25% per year on the anniversary of the grant date, meaning it's explicitly stated in the agreement. Second is an implicit service period, which, for example, may depend on a goal, such as receiving FDA approval of a drug. You do not know exactly when this will occur, but you need to have knowledge about your business and what is typical in a company to meet the goal. In this case, you record the expense over the period in which you determine when the goal will be met. It's implied from the facts and circumstances. And finally, there is a derived service period. For example, you have a stock price market-based condition such as relative TSR goal or some other stock price condition. How likely is this price condition to occur? Here, you would use a valuation model to determine how likely it is for that market goal to be hit. The model takes into consideration if the goal will be met and when it will most likely happen. In other words, it's derived from a model. Also keep in mind that an award is not required to contain all 3 types of expense attribution service periods. Also, a grant may have a combination of 2 types, such as a performance goal along with a time vesting schedule based on continued employment. And now, on the following slides, we'll touch briefly on some more unique features of expense amortization. So, where vesting requirements are non-substantive, meaning where it is assured that the grant will vest, the service period may be deemed to have already been completed at the grant date or at some time before the stated vesting date. The most common example of this is retirement eligibility provisions, where an employee who is or becomes eligible to retire gets to keep their award, but no longer has to provide service to the company in order to keep it. For example, when provisions are made to employees who will become eligible for retirement before the stated vesting period is complete, the expense should be recorded over the shorter of either the stated vesting period or the period in which the employee becomes retirement eligible, which may be at the grant date or at a date after grant but before the stated vested period ends. These non-substantive requirements can lead to varied recognition periods for the accounting expense, even though you may have a fixed grant date fair value. So now let's look at an example on the next slide for another expense attribution concept. So for options and awards with cliff vesting, the expense is attributed or accrued or amortized on a straight line basis over the entire vesting period. However, for options and awards with graded vesting, such as monthly, quarterly, or annual vesting, ASC 718 permits 2 different attribution methods. First, the expense can just be recorded on a straight line basis over the full service period, provided that the amount of expense recorded at any point is proportionate or ratable to the percentage of the option or award that is currently vested. Or the expense can be recorded in an accelerated manner where each vesting increment or tranche is treated as a separate award, which is sometimes referred to as the FIN 28 approach, since this approach was first introduced in the FASB interpretation number 28. So let's assume a company grants RSUs with a total value of $120,000 on January 1st, 2019, and the award vests in 3 equal annual installments, or 1/3 per year over 3 years. If the expense is accrued on a straight line basis, the company recognizes the expense as shown in the top table of the slide. However, if the expense is accrued using the accelerated method, the company recognizes the expense as shown in the bottom table. Under the accelerated method, the expense associated with each tranche is recorded on a straight line basis over the service period for that specific tranche, and the expense is recorded for all tranches simultaneously, starting from the date of grant. This causes more expense to be recorded earlier in the service period, in effect front-loading or accelerating the expense accrual. So why would a company ever want to front-load or accelerate the expensing? Well, the next slide gives a couple examples of where expense acceleration is required. So regardless of whether or not the vesting is ratable, meaning, for example, if an award has tranches that vest 1/3 per year over 3 years or 1/4 per year over 4 years, if the vesting is graded, whether it's ratable or skewed otherwise, IFRS 2 requires the use of the accelerated or FIN 28 front-loaded approach to expense attribution. In other words, there is no choice for straight line expensing like there is under ASC 718 for ratable vesting. Also, if the award contains either a performance condition or a market condition, ASC 718 requires the use of the accelerated method for expense recognition. But in either method, whether it's straight line or accelerated, the amount of expense recorded at any point in time must be proportionate to the percentage of the option or award that is currently vested. Okay, let's now move on to the topic of forfeitures, starting on the next slide. So in most cases, accounting expense is recognized only for equity award arrangements that actually vest. And where vesting is contingent upon continued service, and options or awards are forfeited before vesting, no expense is recognized for the forfeited shares. And any expense previously recognized for the forfeited shares is reversed to the extent that actual forfeitures are greater than the estimated number, assuming the company estimates forfeitures up front. However, and this is important as noted on the bottom of this slide, expense is not reversed for awards that vest but then subsequently expire unexercised, or for underwater options that are canceled as part of a repricing or an option exchange program. Also, for awards with performance conditions not tied to a stock price, expense may be adjusted or reversed for not meeting the performance condition. So more on forfeitures on the next slide. So in 2016, the FASB issued ASU 2016-09, which amended ASC 718 and allowed companies to make a one-time accounting policy election on how to account for forfeitures on service-based awards, to either account for forfeitures as they actually occur or continue to estimate forfeitures up front as was previously required. And this policy election applies to all service-based awards granted by the company. In other words, it cannot use estimated forfeitures for some and actual forfeitures for others. So if the company elects to record forfeitures as they occur, then at each reporting period end, the company would determine the total percentage of awards that remain outstanding, calculate the amount of expense that should be recognized up to that point for the remaining awards, and then subtract any previously recognized expense from this total. The difference is the amount to recognize in that period for actual forfeiture. Alternatively, we have an example on this slide that shows a grant in which the company applies an estimated forfeiture rate. I won't go over this in detail, but exam candidates should take some time to review and understand the math in this example, including the differences in expense recognition under the accelerated versus the straight line method. So then what happens if a company needs to adjust the original forfeiture estimate to a new forfeiture estimate? Let's move on to the next slide for a good example. So in this slide, here is an example of how to adjust for forfeitures if the company applies an estimated forfeiture rate. Also, this same approach would be used to adjust for a performance award where the actual or expected payout changes from a previously expected payout. So in the example on this slide, you basically recalculate the expense as it should have been recorded using the updated forfeiture rate. Then compare what you have already expensed versus what you should have expensed if that updated rate had been used since the beginning. Then make a true-up adjustment. So if the new forfeiture rate is lower, you would be recording additional expense. And if the new forfeiture rate is higher, you would be reversing expense in the current period from what you would have recorded using the old rate. And this adjustment is done the same way under the accelerated attribution method. You would just calculate a separate adjustment for each vesting tranche. So be sure to read through this example and other examples in the book so that you understand how to apply a new rate for both methods. And remember, you do not change prior period's expense. You just true up expense in the current reporting period. So for forfeiture considerations related to performance and market conditions, let's move on to the next slide. So for awards where vesting is contingent upon achievement of performance goals, ASC 718 distinguishes between performance conditions that are market or stock price related versus those that are not related to a company's stock. Performance goals that are not related to a company's stock price, but are instead related to the activities or operations of a company or an employee, are referred to as performance conditions. These could include revenue or earnings targets, returns on assets or capital, or even department or corporate profitability goals. For these performance conditions, the company must estimate the likelihood that the performance goal will be met and use that probable outcome in determining how much of the grant's fair value to recognize in each reporting period, and then true up for any changes in the likelihood of achieving those performance conditions. The recognition of expense for these grants is similar to recognition for time-based grants where the company applies an estimated forfeiture rate, as we discussed in the previous slide. Alternatively, goals that are related to a company's stock price, such as a specified price target, shareholder return, or another calculation involving the company's stock price, are referred to as market conditions. And in the next slide, we'll see that there's an exception to the general rule when it comes to treating forfeitures associated with not meeting the market-based condition for vesting. So let's move on to the next slide for that example. So as I mentioned earlier, for options and awards that are subject to market conditions, and you'll see some examples of these on this slide, the stock price condition should be considered when determining the fair value of the option or award initially at grant. And because of that, a more sophisticated pricing model, such as a Monte Carlo simulation, should be used to value the award. And that model should consider all the possibilities that the market condition will be achieved in a large variety of what-if price scenarios. And then the model will adjust the fair value for the expected outcome of those stock price conditions. Because the initial valuation is adjusted for the possible outcomes of these market-based conditions, there is no expense reversal later if the market conditions are not achieved, provided, of course, that the required service conditions are met. And as mentioned earlier, for options and awards that are subject to non-market performance conditions, the valuation is computed without regard to the performance conditions and expenses recognized only for the portion of the option or award that vests. Okay, let's move on to a new topic on the next slide. So let's talk about some transactional issues and their accounting impact. Any provision that permits employees to finance the cost of their exercise by tendering either previously acquired company stock or using a portion of the shares currently being exercised generally does not affect the accounting treatment of the option under ASC 718. But always make sure to check that your plan allows for these types of exercises. Also, ASC 718 permits the tender of shares to cover required tax withholding payments. However, where shares are tendered from those currently being exercised, in the case of a stock option or SAR, or for an award release in the case of restricted stock awards or units, the tax withholding must be limited to the maximum individual tax rate in the employee's jurisdiction. Allowing employees to tender exercised or released shares for tax payments in excess of the maximum statutory amount will trigger liability treatment for the grant in question. And furthermore, if the transaction is part of a pattern, or if the terms of the plan specifically allow employees to tender shares in excess of the maximum required tax payments, liability accounting may be required for the entire plan and not just only on the grant in question. And also remember, the company is paying the IRS in cash and not in shares of stock. And finally, under IFRS 2, if shares are tendered to cover taxes in excess of the minimally required tax withholding, only those shares used to cover the taxes are treated under liability or mark-to-market accounting. The rest of the award can still receive fixed accounting treatment. Okay, now let's talk briefly about modification accounting on the next slide. So under ASC 718, any material change to the terms of an option or award is considered a modification. And the standard defines 4 types of modifications, aptly named types 1, 2, 3, and 4. And in 2017, the FASB issued ASU Topic 2017-09, which amended ASC 718 to clarify which types of changes to awards must be accounted for as a modification. In this Level 2 exam, the focus is on understanding the concept of what a modification is, as well as a basic understanding of what constitutes a Type 1 modification. So Type 1 modifications include such things as option repricings, acceleration of vesting, and the extension of the option term, and are viewed as a cancellation of the original option and the grant of a replacement option. In a Type 1 modification, the cancellation of the original option is not treated as a forfeiture, and thus none of the expense previously recognized for the canceled option is reversed. Furthermore, if the canceled option is not yet fully vested, the company continues to record the remaining unamortized expense along with any additional expense for the new replacement option. And the expense for the replacement option is equal to its fair value less the fair value of the canceled option at the time of the cancellation. Also, remember that modifications do not always trigger an additional expense. It all depends on the facts and circumstances. More about modifications, especially the other three types, will be covered on the Level 3 exam. Okay, now let's talk about some accounting issues related specifically to ESPPs on the next slide. So under ASC 718, a company must calculate and recognize compensation expense for its ESPP over each purchase period, unless the plan qualifies for a limited exception for what are called non-compensatory plans. To be considered non-compensatory, an ESPP must meet all of the following three requirements. First, there can be no more than a 5% discount in the plan, which is sometimes referred to as a safe harbor discount, which is basically equal to or less than a company's cost of raising capital through a public offering. Second, the plan cannot incorporate any option-like features such as a look-back provision, under which the purchase price is based on the lower of the market value of the stock on the enrollment date or the purchase date. And third, substantially all employees must be permitted to participate in the plan on an equal basis. So plans meeting the rules for Section 423 ESPPs automatically qualify under this requirement. So if your ESPP does not qualify for non-compensatory treatment, then the fair value of an ESPP for accounting expense purposes is comprised of up to three components. First, for all ESPPs, the fair value includes the discount provided under the plan as calculated on the enrollment date. Second, for ESPPs that include a look-back provision, and let's also assume the discount is 15%, the fair value also includes 85% of the value of a call option granted with a price equal to the market value of the underlying stock on the enrollment date. This component of fair value represents the additional value employees will realize as a result of the look-back if the stock price increases during the purchase period. And third, for ESPPs that do not limit the number of shares that employees can purchase if the price declines during the purchase period, the fair value also includes 15% of the fair value of a put option with a price equal to the market value of the underlying stock on the enrollment date. This component represents the value of additional shares employees will be able to purchase if the stock price declines during the purchase period. And note that both the call option and the put option mentioned here are determined using an option pricing model. Also, where a plan allows for multiple purchases during a single offering period, each individual purchase is valued as a separate option. So, for example, a 24-month offering that provides for 4 purchases to occur at 6-month intervals throughout the offering is treated as 4 options: a 6-month option, a 12-month option, an 18-month option, and a 24-month option, with a separate fair value computed for each option. And straight line or accelerated accruals are accepted recognition methods, and expense is estimated based on the participants' contribution rates. And just like for stock options, we have a forfeiture rate that reduces our expense. If an employee terminates, the expense recorded is reversed. But here's an issue that many people find confusing. If an employee voluntarily withdraws from the ESPP or reduces their contributions, expense is not reversed for those instances. They are not forfeitures, as the requisite service period has been completed. This is like letting an option expire unexercised. Finally, rest assured that you will not have to perform any fair value calculations on the exam, but you should be familiar with these concepts and requirements. Okay, let's move on now to the topic of tax accounting on the next slide. So When you grant a non-qualified stock option, RSA or RSU, your company will get a corporate tax deduction at exercise or release, which reduces the company's overall tax expense. So a DTA, or Deferred Tax Asset, is an accountant's way of holding or recording that future tax benefit. There is a very prescribed way of booking the DTA. You take the fair value that you are expensing and multiply it by the corporate tax rate. So if you are recording $1,000 in expense and your corporate tax rate is 20%, you record a DTA of $200 along with the expense. And you book these together during the company's expense recognition period. Then, when the exercise or release actually occurs, you have to reverse that DTA because you no longer have a future tax benefit, you actually have a real current benefit. So then you have to compare what you have accumulated in the DTA account with the actual tax benefit that you receive. And as you can imagine, it's never a perfect match. In most cases, the expense that companies recognize for stock compensation differs from the tax deduction they are entitled to for the awards in both timing and amount. For example, for a non-qualified stock option, expense is recognized over the service period of the option, but the company is not entitled to a tax deduction until the option is exercised. In addition, the accounting expense is generally the fair value of the option as determined at the grant date, whereas the tax deduction is the spread or intrinsic value at exercise. These differences must be reconciled and accounted for in the company's financial statements. So for awards that normally result in a tax deduction for a company, such as NSOs or RSUs, the company records the DTA based on the future tax deduction the company expects to receive. This deferred tax asset is then written off when the company does ultimately become entitled to a tax deduction. At that time, the tax savings resulting from the deduction is compared to the amount of the asset that was recorded for the arrangement. If the actual tax benefit is more than the deferred tax asset, the excess is recognized as a tax benefit or a reduction to tax expense. However, if the actual tax benefit is less than the deferred tax asset, the shortfall is treated as additional tax expense for the period in which the exercise or RSU release occurs. So we've talked about NSOs and full value awards, but what about qualified arrangements such as ISOs and ESPPs? Let's go to the next slide for that discussion. The treatment of tax-qualified arrangements, such as ISOs or Section 423 ESPPs, is a little different. For these arrangements, the company is entitled to a tax deduction only if the participant engages in a disqualifying disposition. We know that there will be disqualifying dispositions, but the IRS tax code does not allow companies to anticipate that ahead of time. Instead, the disqualifying disposition must occur in actuality in order for a company to get the tax deduction. At the time expense is recorded for these qualified arrangements, it is assumed that the company will not be entitled to a tax deduction, and therefore the company generally does not reduce tax expense during this period. And so it is not necessary to record a deferred tax asset for these types of arrangements. Thus, the expenses recorded for tax-qualified arrangements is a dollar-for-dollar reduction in profitability for the company. It's not offset by any reduction in tax expense during the accounting expense recognition process. So then what happens when a disqualifying disposition actually occurs? It's at that point when the company becomes entitled to a corporate tax deduction, and so it then can reduce its tax expense in the period in which the disposition occurs, but only to the extent that the deduction does not exceed the expense recognized for the arrangement. If the tax deduction exceeds the expense, the tax savings resulting from the excess is recognized as additional paid-in capital. There are some good examples in the books regarding DTA calculations, which you should be familiar with for this level 2 exam. Okay, let's move on now to our final topic of earnings per share. So, under ASC 260, which is the accounting standard for earnings per share, or EPS for short, companies are required to report two kinds of EPS computations. The first is what's called basic EPS, which reports the company's net income available to common shareholders divided by the weighted average number of common shares actually outstanding during the period. This computation does not include stock options, unvested restricted stock, or other stock awards. You do include options that were exercised during the period, and these options are weighted depending on when and for how long they were exercised during the reporting period. The second type is called diluted EPS, which is the same as basic EPS, except that the denominator is increased to reflect any outstanding common stock equivalents. Common stock equivalents include stock options, stock-settled SARs, unvested restricted stock awards and units, convertible preferred stock, warrants, and other arrangements under which the company may be obligated to issue stock in the future. To calculate the common stock equivalents, companies use what is called the treasury stock method, which is like a worst-case scenario. What would happen if everything that is outstanding were all of a sudden exercised or issued as common stock? And by the way, we are not going to discuss warrants or convertible preferred stock in this webinar or in the CEP program. So let's just look at the first bullet under unissued stock on this slide. And so moving to the next slide, as I had just mentioned, the number of common stock equivalents that must be included in the denominator for diluted EPS is computed using the treasury stock method, which is like the worst case dilution scenario. First, options and awards are weighted for the length of time that they are outstanding during the reporting period. For example, if an option for 1,000 shares were outstanding for only 1/4 of the reporting period, then only 250 shares, or 25% of the option, would be included in the calculation. Second, the company assumes that the weighted options and awards are fully exercised or issued and released. And this assumption is required regardless of the vesting status. Full exercise is assumed even where the options are not yet fully vested. So as you may imagine, these instances can really dilute a company's earnings per share. So in order to help mitigate the dilutive impact of adding these shares from assumed vestings, exercises, and issuances, the company is able to use what is called hypothetical proceeds that it would realize for the assumed exercises, issuances, and releases to repurchase its own stock. And this assumption applies even when the company does not have such a repurchase program in place. So now let's look at the impact of these hypothetical proceeds on the next slide. These assumed or hypothetical proceeds may include up to two types. One, the exercise price of the option or any amount paid for the issued stock. And second, the average unrecognized expense for the grant over the reporting period, excluding the effect of estimated forfeitures. This average unamortized expense for the grant is considered an additional source of proceeds that the company could use to repurchase its own stock. You then add up these hypothetical proceeds, divide by the average price of the shares during that reporting period to figure out how many hypothetical shares you would be buying back. This number would then be used to reduce the number of common stock equivalent shares in the denominator of the diluted EPS calculation. But in the world of accounting, there are always exceptions to the rule. So let's go to the next slide for those exceptions. So any stock option that would have the effect of increasing earnings per share are considered to be anti-dilutive and are therefore excluded from the calculation in their entirety. Your diluted EPS should always be less than your basic EPS. So options that would increase the EPS calculation are therefore excluded completely. Underwater or out of the money options are also considered anti-dilutive and thus are not included in diluted EPS. However, even in the money options can be anti-dilutive. And as you can see on this slide, if the unamortized expense causes share repurchases to exceed the total options outstanding, then they would be anti-dilutive and would be excluded from the calculation. And finally, restricted stock is not considered issued and outstanding until it is vested. And so while the award is unvested, it's basically treated as a stock option with a price of 0. Be sure to read the chapter on EPS in the accounting book for some good examples on these calculations. And so, Pam, I think that's it for this Level 2 accounting webinar.
That's great. Thank you, Steve. So we have some suggestions of other places that you can find education if you are wanting a little bit more information or courses that might assist in your exam preparation. We aren't endorsing these, and we will make a point of saying that the tests are written based on the books and only the books, and if there's a uncertainty about a question or you should definitely refer to the textbooks as you are taking the exam to answer those. This webinar in and of itself is not sufficient exam preparation. The webinar is available to you for unlimited viewing until the exam date. The same is true for all of the webinars in this series. And on that note, thank you very much, Steve, and good luck on the test, everyone.